Same starting point, $70,000 saved, $80,000 income. Same mid-sized city, same year, same $350,000 home on the market. One path leads to buying that home. The other path leads to renting a nearly identical home and investing the difference. 20 years later, one path ends in a paid-off house worth over $500,000. The other ends in an investment account that, for over a decade, actually wins before losing that lead for good. Here's the problem with almost every rent versus buy breakdown out there. The buying argument leads with the ending, a house 20 years from now called proof. The renting argument leads with flexibility and freedom and quietly skips the long-term cost of never owning anything. Neither argument runs the full math. This one does. Closing costs that get buried before move-in day, mortgage interest that eats almost the entire payment in year one, property taxes that grow every time the home appreciates, a maintenance budget that never shows up on a real estate thumbnail, and the number almost nobody calculates. What actually happens if every dollar not spent on a mortgage gets invested instead for 20 straight years? By the end of this, the real break-even point on buying versus renting will be on the table. Not the version that sounds good in a headline, the version that holds up in a spreadsheet. This channel runs the full math on financial decisions every week. Subscribing means never missing the breakdown that actually adds up. Two identical financial starting points, $70,000 in savings, $80,000 in annual income, a $350,000 three-bedroom home in a comfortable neighborhood. Path 1, buying, a 20% down payment of $70,000, avoiding private mortgage insurance entirely, a 30-year loan at 7% interest, principal and interest, $1,863 a month, property taxes, $350 a month, insurance, $150 a month, maintenance budgeted at a conservative 1% of home value annually, $290 a month, total monthly cost of ownership, $2,653. Path 2, renting, a comparable three-bedroom in the same area for $2,000 a month. The $70,000 that would have gone toward a down payment goes into a total stock market index fund instead. The $653 monthly difference between the ownership cost and the rent gets invested every single month. On the surface, the renting path looks like it found a loophole, a nearly identical home for $653 less, with the full $70,000 still working in the market. But here's what almost never gets said out loud. The moment the buying path signs at closing, it is not ahead, it is behind, and not by a small margin. Closing costs on a $350,000 home typically run 2 to 5% of the purchase price. Lender fees, title insurance, attorney fees, prepaid taxes, escrow setup. A $70,000 down payment turns into a real day one cost closer to $82,000 to $88,000. That gap has to be earned back before buying even starts to outperform renting. Real estate marketing rarely mentions this number because it makes year one look bad. It is standard, it is real, and it comes due at the closing table. Why equity in year one is a myth. Home ownership arguments love to talk about equity from day one. What gets left out? In year one of a 30-year loan at 7%, almost the entire payment is interest, not equity. Of that $1,863 monthly payment, roughly $1,633 goes straight to the lender as interest. Only $230 reduces the loan balance. Add taxes, insurance, and maintenance, and $2,623 a month goes out the door building no equity at all. Only $230 of that payment is doing what most people assume the whole thing is doing. Meanwhile, the renting path spends $2,000 a month with the same result, zero equity, but a lower number attached to it. In year one, renting is the cheaper way to build nothing. Year 3, the fantasy meets the spreadsheet. Over 3 years, total housing cost on the buying path comes to roughly $95,500. Principal, interest, taxes, insurance, and maintenance combined. Only about $8,300 of that has gone toward actual principal. The remaining mortgage balance sits near $271,700. At 3 to 4% annual appreciation, the home is now worth $383,000 to $396,000, putting equity somewhere between $111,000 and $124,000. Real wealth, but locked inside a structure that costs 5 to 6% in commissions to unlock. On the renting path, total rent paid over 3 years comes to about $72,000. The original $70,000 investment has grown to roughly $93,000 at historical market returns, and the monthly contributions add another $27,000. Total invested wealth, approximately $120,000, slightly ahead of the equity built on the buying path and fully liquid. The costs nobody budgets for into 7 o'clock. If this breakdown is already showing the parts of the debate that usually get skipped, hitting like helps this reach more people watching this exact comparison. Selling costs on the back end rarely make it into the analysis. A 5 to 6% commission on a future $500,000 sale is $25,000 to $30,000 gone at closing. Combined with the cost of buying in, total transaction drag over a full cycle often runs 8 to 10% of the home's value. The hurdle appreciation has to clear before ownership actually outperforms. Property taxes rise with assessed value, so a home that appreciates from $350,000 to $500,000 brings a higher tax bill along with it, even while the mortgage payment itself stays fixed. On the renting side, rent also rises, but the landlord absorbs the tax exposure, not the tenant. And maintenance is never a flat $290 a month in practice. Budget years look like caulk and light bulbs. Reality years look like a $9,000 roof, a $7,500 HVAC system, a $4,000 foundation repair. These costs are guaranteed over a long enough timeline. Skipping the budget for them isn't saving money, it's borrowing against a bill with no announced due date. The number that almost never appears in homeownership math, opportunity cost. A $70,000 down payment is gone from the market the moment it's wired to closing. At a 10% average annual return over 20 years, that same $70,000 would grow to approximately $470,000 in a total market index fund. That is not a loss. It's the alternative outcome traded away for home equity. Any honest comparison has to count both sides of that trade. Subscribing now means catching the follow-up video, modeling exactly what these numbers look like when both strategies get combined. By year 10, the buying path shows a home worth $483,000 to $500,000, a remaining mortgage balance near $246,000, and equity between $237,000 and $254,000. After $30,000 to $40,000 spent on maintenance and repairs along the way. The renting path's original $70,000 has grown to roughly $181,000. Monthly contributions, averaging around $580 as rent climbed, add another $110,000. Total liquid portfolio, approximately $291,000, still ahead of the equity on the buying side. But something has shifted. Rent has climbed to nearly $2,690 a month, closing in on the fixed mortgage payment with nothing building underneath it. Year 20 and year 30. By year 20, the buying path shows a home worth $670,000 to $700,000, a mortgage balance down to roughly $188,000, and equity between $482,000 and $512,000. With monthly housing costs still anchored near that original $1,863 payment, the renting path's portfolio sits between $550,000 and $580,000, only slightly ahead, and only if every market correction was held through without touching the money. Rent by this point has climbed to roughly $3,600 a month. By year 30, the buying path owns the home outright, worth $850,000 to $950,000, with monthly costs dropping to just taxes, insurance, and maintenance, around $900 to $1,100. The renting path is still paying rent, now $4,700 to $5,000 a month, with no asset and no floor under the cost of living. The honest catch on both sides The renting and investing strategy only works with perfect consistency, investing the difference every single month, including the months the market drops 30%. The data on whether that discipline actually holds isn't encouraging. Lifestyle creep tends to absorb the gap long before it compounds. A mortgage payment enforces that same discipline automatically, which is part of why ownership tends to outperform the theoretical spreadsheet for the average household. But the buying side has its own blind spots. The real break-even point, after accounting for closing costs, selling costs, and the interest-heavy early years, typically lands between year 5 and year 7 in a normal market. Buy and sell inside 3 years, and there's a real chance of coming out behind. Concentration risk is also real. A home is one asset in one location with no ability to rebalance if that specific market stagnates or drops. And liquidity matters more than it seems until it's needed. Equity can't cover an emergency without selling or taking on new debt at a new rate. Buying wins clearly with a 7 to 10-year minimum timeline, a price-to-rent ratio under 20, and a market that appreciates above the national average. Renting wins clearly with a shorter timeline, a price-to-rent ratio above 25, and enough discipline to actually invest the difference every month without fail. The real question was never which path wins on average. It's two questions: how long is the actual stay, and will the difference actually get invested? Everything else in this comparison flows from those two answers. If this made renting versus buying clearer than the version that only tells half the story, liking this video helps it reach more people asking the same question. Subscribing to Kone Invest means weekly breakdowns of financial decisions, full math, no agenda, and dropping a comment below on Team Rent versus Team Buy. Every single one gets read.